Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about how we can sometimes underestimate what it takes to make up losses when they occur.
It's an interesting phenomenon.
And what we mean by that is, we've got this long time horizon. We're investing in the stock market, and the stock market has a down year. And so what we think in terms of to make up what we lost in the stock market that down year is often misunderstood. And there's a couple ideas that we want to go over with you, and specifically what to do to help combat them. So before we dive into that though, Mr. Collins, what are you drinking?
Today I am drinking, shockingly, a hazy IPA. It's hazy in the gorge. So this comes from Backwoods Brewing out of Stevenson, Washington, down on the Washington-Oregon border. This is just a really good beer.
I've never had that one actually, so I'd be curious on that one. Does that say Kona, the cup?
Yes.
Yes. Love Kona Brewery. Specifically when I'm there.
Yeah. So this is it's a pint glass that my wife and I picked up actually on Kauai, drinking Kona beer.
Very cool. Well, I'm drinking the Alpenhaze. Shocker, ooh. I know to our listeners, hazy IPA, and it's from Icicle Brewing Company. It comes in at a 6.3 alcohol by volume, but it's one of my favorite hazy IPAs out there in Eastern Washington. So cheers, Alex.
Cheers.
So let's dive into today's topic, right? So we're going to use a couple different time periods today, but imagine you are, we're going to start with a 10-year time horizon. So imagine you are 10 years away from what you think may be your retirement year, right?
Okay.
And you've got $1 million invested, and let's just say it's invested in 401k. We're going to keep it ultra simple. We're not going to get into taxation today. This is all about recovery rate. So you got $1 million, 10 years away from retiring. And let's just say 5 years in. So you're 5 years away from hoping to retire. And that's the year that the market is down.
Okay. So kind of like it was a couple years ago.
Exactly. So 2022, we're actually going to use kind of similar rates of return. So 2022, the market was down. I'm going to use a 22%. It's down negative 22%.
Okay.
So again, you're 10 years away. So you still have another 5 years to recover, even though you went down 22%. So if I were to ask you, Alex, take your financial planning advisor hat off for a second. And if you're a client and you're thinking like this, what do a lot of people that we speak to, if I were to ask you, hey, what do you have to do to make sure that you're still on track for retirement and you end in year 10 with roughly the same amount of assets or the same net worth that you did prior to the downturn in the market?
Oh, got it. I need to recover that 22% loss.
Exactly. And so our math in our head, quick math, most people say, well, I gotta gain 22% to offset the negative 22%. So we're going to go through an example of why that's actually mathematically wrong. And I don't mean to say that in a demeaning way. It's just our brain thinks, oh, I lost 22, I need to gain 22. So on its highest level, it seems to make sense, but mathematically, that's not actually the case. And we're going to go through an example of what that is. So let me share my screen here real quick. And Mr. Collins, make sure you tell me that it is being shared. You give me the thumbs up. For those of you listening into the car, by the way, make sure you check out the YouTube channel. That way you can see the video component or the visual side of today's episode, because I think it will help. So again, if we're talking that 10-year study period, Alex, and as I mentioned, it's $1 million asset that we started with. And let's just say, I forgot to mention this, you're saving money still, right? You're 10 years away from retirement, so you're still saving money. We're going to say we're putting 40 grand into the retirement accounts. This is, a married couple.
Spouses plus
correct
employer contributions, etc.
Yep. And so we're putting an annual payment towards the investment of 40 grand a year. And we're going to use a fixed rate of return of an 8% rate of return, which is a common number. Like oftentimes when we talk to clients without, at least in that first meeting, and we ask them like, what's the rate of return you'd like to get or average? they give us like an 8% rate of return number. Sometimes they go as high as 10, but that tends to be the average that we get.
Yep. And this is not saying that we're putting something into a fixed income vehicle, getting an 8% rate of return. This is making an 8% assumption as our rate of return on variable assets.
And again, as I mentioned, in year 5, there's a downturn in the market and it's negative 22%. Okay? And so what that means is now year 6 through year 10, well, that's the recovery time, right? So the answer to this question is, as we've already started, most people think, okay, I lost 22%. I just need 22% to get back where I was on track for. Well, when we show the math here real quick, you can see we get to year 5 and there's that downturn, right? So the downturn, the bar chart says, well, if we were getting an 8% return every year, we should be at 1.7, but we just lost 22%. So we actually went down and we're at 1.2, right? We should be at 1.7 if we got the 8%, but we're at 1.2. And if we kept getting, if we go back on track and we're at 8%, well, here's where the difference is, right? We've got year 10, we're at 2.7, almost $2.8 million. But
that
in
2.8
reality
is where we expected to be.
Correct. But in reality, we're at 2 million. So we're $800,000 shy of our goal. And so the question is okay, what is the recovery rate? What did we actually need as a rate of return? And in a 1-year bump. So let's now go backwards, Alex. Right?
So in a 1-year bump, change that 10 to 7.
Correct. So in the 1-year bump, if we wanted to get back on track the very next year, which is what most people think may happen, here's what we need as a true recovery rate.
That's
26%.
Right.
26%.
That's a huge year.
And the very next year. And I'll just hit recalculate here to show this. And you can see how, yeah, we get right back on track. That's the recovery rate of return that we need. Now, over time, and this is what a lot of people may think, well, I've got year 6 through year 10. So I've got this 3 or 4 year period of time.
Well, actually, Ryan, hold on just a second. The way that calculator was actually doing it, if we use 7, that's showing a 26% rate of return for 2 years. Change that to 6 real quick.
Good point. So it's actually 48% in a 1-year bump.
Click recalculate to show it bouncing back in 1 year. So what that is that 48% is showing recovering the 22%, plus then also gaining the 8% for the down year and the 8% that we were supposed to get in year 7. That's why it's so much bigger, is that it's really trying to recover all 22% in 1 year. And since it's 22%, but off that we need to recover, but that's off of a lower number, we need to get a bigger number there. Plus then we missed out on the 8% in the year it was down. Plus then we need to also take into account the 8% on the year that we were supposed to get. That's what makes it 48%. It's a huge, huge ask to get back there in 1 year. And in fact, most advisors, most planners would say it's incredibly unlikely to get it back all in 1 year.
At a 48% rate of return, yeah. I mean, the risk level on that would be extremely
Through
high,
the roof.
right?
Right.
So now let's take this out to, again, this person, most people are still thinking, well, they don't need to recover it all in 1 year. They just need to recover by the time they retire. Now, Alex and I have recorded plenty of episodes around this thing called market timing. Like, we don't know what's going to happen, but if we could, and we're just planning on the next, 4 years of, what do we need to have in terms of the market a rate of return to get back to where we were. Now we're looking at almost a 15% rate of return, right? And I'll hit calculate again. And now you can see, right, we still have the downfall in year 5, and then it slowly comes back over time, but it averages a 15% rate of return over those next 5 years. That's adding risk if you're looking at it from the standpoint of bringing that back to what you were on pace to have.
and a very significant amount of risk. We're talking about massively increasing the risk and doing so after a down year, right before retirement.
And this is where we get to the point of, and this is where Alex and I mean, a lot of times we actually get clients because of this, is they had plans to retire a certain year, something doesn't go as planned, and next thing you know, they want to talk to an advisor on like, how do I get this back on track? How do I still retire when I want to retire? Or really the question is, can I still retire even though I lost 22% 5 years ago?
Right. And it becomes more a question of how can I create better cash flow in retirement from like now a lower asset amount? What are the things that I need to do? Do I need to wait a year or 2 years? Like, what do I need my assets to get to? What are the different ways that I can make up this gap that's been created?
And our answer to that, obviously we can go into the retirement income planning. We've got plenty of answers for that. But the answer to how do we plan for this, right? What's the solution? Is we need to make sure we've got money in the market. We're putting money in the market over the same time period, but we're also putting money outside of the market. I want to clarify outside of the market. I'm not saying that you put money in cash and you put it underneath your mattress. I'm just saying that we've got money in an account or in an investment that is not correlated with the stock market, right? That's where this gets key, because most people, right, when we ask them where they've been putting money, most of the time it's in 401ks or retirement accounts, and maybe they've got some amount of money in investment accounts. But the issue that arises is they're relying upon rate of return to make or break them. Because even when this person retires, they're still going to have money in the market. And the stereotypical way about going about this is, well, over time, I'm going to de-risk, which means I'm going to have less stocks and more bonds.
Which means that we're going to wind up with a lower rate of return, which means that we're going to wind up with less cash flow. Like this winds up becoming a cyclical
it's
conversation.
still a rate of return conversation, and it's still a reliance or hope on that. And what Alex and I try to speak into, we're not trying to say that should be like a 50-50 split. That's for a whole different conversation. It's more of, you should be building money outside of the market on the balance sheet over decades, so that you're not reliant upon the market to make or break you. Because imagine if this person, maybe they didn't put the 40 grand a year into the 401k. Maybe, and I'm making up numbers here, they put 35 or 25 in the 401k, and they took the other money and they put it outside of the market. Now, in theory, they could be adding more years to allow this money to come back, because they've got other money that they can pull from that was not affected by the 1 year downturn 5 years ago.
This gives us a much slower scale in terms of the recovery rate. It gives us a place where we can pull money from a short-term time period to be able to accomplish the same desired cash flow. It allows us different potential distribution methods so that we can increase the cash flow from the same amount of dollars. It goes back to one of our previous podcasts where there's about 5 or 6 different major factors on where we can pull money from and what can affect our retirement cash flow. And so by having dollars that are both in the market and out of the market, it gives us a lot more flexibility to be able to create the picture that you want to have and make it so that we're less reliant upon the market, especially in those last couple of years before retirement or first couple of years in retirement.
And this should hopefully debunk another myth out there in terms of like, well, we hear this all the time. Well, I want to make sure I'm getting a rate of return on my money. So again, it goes back to that rate of return conversation. And I think some people, when they hear, well, you're telling me not to put money in the market, Ryan and Alex, I'm going to lose money. Now the time value money is going to be too big. That doesn't make any sense to do. And what we're trying to explain is like the reality of life, for one. Right? If we could work off spreadsheet math, retirement planning, like this becomes very simple, but unfortunately, like life isn't spreadsheet math. And then 2, like, do you want to have to rely upon rate of return, or do you want some sort of control over when you retire? Which is I would argue if we asked that question of 100 people and we said, hey, do you want to control when you retire or do you want to rely upon something else for retirement? I'm going to guess that 95% are going to say, I'd rather control when I can retire.
And so much of this goes back to understanding how to actually create cash flow in a retirement and what the difference between cash flow and rate of return winds up being so that we can create consistent cash flow at retirement with a way to have more flexibility so that when the market punches us in the mouth, we've got a way of being able to react to it and not just get knocked down.
Yeah, because in this person's lifetime, chances are they're going to have at least one more down year. Right? This is just
Right.
getting them to retirement, right? So, look, today's episode was debunking the myth of, well, if I lose 20% or 22%, I just need 22 to get it back. That's myth number one. Myth number two is the over-reliance, or I have to have a high rate of return to control when I can retire. And that's not accurate either, right? It's all about where you're putting money and understanding how retirement income comes into play, which takes us, Mr. Collins, to the question of the day.
Our question today is, how reliant upon the market are you? And if you're not sure and want to have somebody review this stuff for you, head on over to beerandmoney.net and let us know that you are looking for someone to review this for you.
Yeah, at the top of the page, there's a contact us. You can either reach out and say, hey, would you or Alex have a conversation with me? Or if this bubbled up any questions for you, maybe you think maybe there's something we missed. And you're like, hey, Ryan, Alex, you forgot about X. Or actually, Ryan, Alex, this was great, but I'm wondering about Y. That's a great spot for you to reach out to us with those questions. Look, we started this podcast to help you think differently about your money, not from the standpoint of like money is all things, but from the standpoint of like, what life do you want to live, right? How do you want to spend your time? And what type of obligations do you want to have? So we hope this episode was valuable for you. And as always, Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
745924.1. Expiration date December 2026.